Hey guys, thank you so much for signing up for the free system building training. I'm really excited for what you're going to learn over the next couple of videos. So what I'm going to show you is an overview of the common different types of trading systems that you can build and a step-by-step process for conceiving, prototyping, optimizing and implementing a trading system of your own that can power your own sustainable trading business. And I hope it's going to spark something in you that's going to make you put in the work to want to transform your trading completely and forever. And I also hope that this transformation doesn't take years and years like it took me. I hope I can help you avoid some of the blind alleys and dead ends that I went down by showing you a really simple step-by-step process to come up with a trading system that suits your market beliefs, your financial goals, and your lifestyle requirements. So my experience is that most people don't trade with a system simply because they don't know how to build a system, or because the only types of trading systems they've seen are perhaps old ones like the turtles, which might not work very well anymore. Or perhaps they got involved with mentors who didn't know how to build systems and were just trying to tell them that you get better at technical analysis and then you'll be a better trader. And for me, that's the number one misconception of trading, is this idea that you'll get better and better at reading the charts and that will somehow magically translate into earning more money. That's a myth that persists for a long time because reading charts is fun and it's interesting and I find it endlessly fascinating. But my experience is that when I look at the best traders I know, the guys with the best long-term records, they're actually not even as good at reading the charts as I am. And guys who are much better than me at trading, who make more money than me, aren't as good as reading charts. And what this told me is that chart reading is an interesting dead end. It's a dead end to your ultimate trading success. You really need to be doing what the professional traders are doing if you want to make money in the long term. So I want you to understand that you can finally stop Googling on the internet, getting setups and trading systems off people like me, and you can move towards building your own trading setups and your own systems, which are going to be a much closer fit with you. They're going to be much easier emotionally to trade. It's not going to upset you when you're in drawdown, when you're trading your own system, nearly as much as it is when you take someone else's setup and it doesn't work. It always leaves you with a little weird feeling, you know? So today in this video, we're going to have an overview of the different types of trading systems that are available, and I'm going to help you narrow it down until there's only probably one or two obvious choices for you to go. And then in the next video, we'll start to look at how to prototype that system and test, is it really an edge? I'm going to show you how to test whether something is a real edge in the marketplace. I'm going to show you how to prototype a system out of that edge. I'm going to show you how to optimize that system and back test it thoroughly. And then I'm going to show you how to implement it in a really, really low risk way so that when you finally turn on your trading system for real money, you're not in a position where you're worried that it's going to lose you a lot of money right out of the gate. If you've already bought my price action masterclass or seen my YouTube videos, you're probably going to be familiar with the setups that I use to build trading systems. So I'm going to do a very, very deep dive on showing you how to build fully featured trading systems using those setups which you're already familiar with as a base. And most importantly, we're going to talk about how to put some structure around your trading system and your results and your own performance so that you can monitor how well your system is performing, and so you know what to do if your system is performing less than expectations. So most importantly, I'm going to show you how to put structure around monitoring your system performance and your own performance in executing that system, and show you how to develop a clear plan of attack when something goes wrong. So if your system isn't performing as well as it should, I'm going to show you exactly what to do, how to modify it. And if you're not performing as well as you can in executing your system, as in you're making mistakes in execution, I'm going to show you what to do about that as well. The things that separate professional traders from amateurs are really simple. It's the stuff that we talk about on the mailing list all the time. You're trading with a system. That system has to have an edge. It has to have an edge. If it's not an edge, you're just wasting your time. You need to keep proper records, and this is key. You know, keeping proper records is the number one predictor of trading performance. You need to be trading that system, making very few, almost no mistakes. And you need to be monitoring your records and reviewing them regularly. And if you're doing those things, if you're doing all those things, then I'm here to tell you that you're trading perfectly and your work is done. There's nothing more you can do. You know, that is what professional trading is. You've got a system, the system is an edge, you keep proper records, you're not making any mistakes, and you're reviewing those records regularly. That's it. You can set aside this idea that you're just going to be learning to trade and move to, I'm a professional trader. So the system is key, right? So where do we start? You know, we start with our goals and our capabilities. So imagine you get into a car, you have to go on a long journey. What's the first thing you do is you enter the destination in Google Maps and your GPS. So your GPS is the goal. Where am I trying to get to? Am I trying to pull money out of this account every week to pay my rent? Am I trying to compound a savings account into a great fortune? Am I trying to take a tiny little $1,000 or $5,000 account and turn it into some meaningful sum of money? Am I trying to compound over 30 years a small retirement account into a multi-million-dollar retirement account? Am I trying to get rich really quickly and earn a lot of money quickly, and am I willing to take some risks along the way? So our goal depends on where we're trying to go. You know, what percentage return are we trying to make? What expenses do we have? We've got a very different situation if you need to live off the income from trading, as opposed to you have a job and you're trading with savings. Because if you have to live off the income of savings, it dramatically alters your income requirements, and it also makes things dramatically more stressful. If you have a bad week and you can't pay your rent, that can put so much pressure on you that it can start a cascade of bad trading. Okay, the next thing we want to talk about is our capabilities. So our capabilities are how much petrol is in the car. We can't drive 1,000 kilometers or 1,000 miles if we only have one tank of petrol and we've got no money. If you're talking about implementing a discretionary intraday pattern-based system that requires a high degree of chart reading skill, if you don't have that degree of chart reading skill, you can't execute the system. If you don't have any chart reading skill, you are limited to certain types of systems, which happen to be very good systems. So you don't need to read charts. You might want to read charts. The type of system that we choose depends very much on our goals and our capabilities. Today, the number one thing that we want to accomplish is to narrow down, out of all the types of systems and all the types of markets, which one is right for you. All right, let's talk about system goals. Usually when I ask someone what sort of goals they have for their trading system, they just say, I want to make a lot of money, I want to make millions of dollars, I want to make as much as I can. But that's not a particularly useful way to approach it. So we're going to go through an exercise now, and I'd like you to get out a pen and paper if you could, and you can write down some things. So let's start thinking about what % per year would you like to earn. Now, the highest earning systems are discretionary based systematic traders. So discretionary systematic traders are the highest skilled traders, and they can earn in a good year between 100 and 200% on the top side, and a lot less than that on the downside. But you have to be extremely diligent. This is full-time work. This is absolute, like driving a Formula One car. There's no room for error. At the other end of that is things we call portfolio rebalancing systems, which you might only execute once a month. They have black and white written down rules, and their goals are to beat the S&P by a couple of % a year, or to average out at about 12% compounding over time. Those low numbers sound really boring, but if you're trading them over many years, it adds up. So what percentage a year do we want to aim for? What amount of money do we need to pull out every year, every week? Do I need to pay rent out of this? Do I need to pay my living expenses out of this trading? It drastically changes things, because if you have to take your living expenses out of trading, this rules out any sort of system where you can have a 3 or 4 year drawdown. For example, trend following systems across the world, every single trend follower in the world has gone through a 3 or a 4 year drawdown recently. So if you're planning on paying your rent, and you absolutely cannot, out of your trading profits, you absolutely cannot be implementing a trading system where you can have the possibility of going 3 years without earning any money. So it rules out things. So the big question, do I need to pull regular money out, and how much money do I need to pull out? So how long are you planning on trading, and how old are you? If you're a guy in his late 50s or a lady in her late 50s, you can't afford a do-over if you make a mistake. So discretionary systems where you might earn a lot of money if you're very good, but you might lose money if you're not performing that well, those are probably ruled out if you're late in life. If you're a 20-year-old young person and you've got time to do over if you happen to make a mistake, I'd be leaning more towards those discretionary systems, because you're probably not going to have a large trading capital to begin with, so you're going to need a higher performing system to justify the amount of time that you're going to spend on it. So let's talk about what drawdowns you're willing to put up with. So usually when I ask people what sort of drawdowns are you willing to put up with, in the real world, people who say they're willing to put up with 30% drawdowns are freaking out at 15% drawdowns. And that's just the truth. So whatever drawdown you think that you're comfortable with, cut that in half and aim for that. How many hours a day or a week or a month are you prepared to spend at the screen, and is that practical? So if you're a mother and you've got to pick up the kids from school at 3 p.m, it's impractical for you to be doing a day trading system where you have to be watching the market like a hawk from 8 through 4. That's actually not going to work for you. It's going to put you under stress. You're not going to perform your personal life or your work life correctly. The last thing I want you to consider is how skilled are you? So certain types of systems, especially discretionary pattern-based systems, tend to be the highest performing types of systems, but they require a high degree of chart reading skill and a high degree of trading psychology skill. If you don't have that level of skill, you're limited in the types of systems that you can build. But the other types of systems that don't require much chart reading skill, or don't require much technical skill, or don't require much time either, those are also fine systems. So what I'd like you to do is just put down some rough notes about financial goals and your capabilities, how much time you have to spend, how much time you're willing to spend, how much skill you have right now. And what I'm going to do now is I'm going to go through some of the common different types of systems, and we're going to go through their pros and cons, how much money they typically make in a good year, in a bad year, and on average. And we're going to start to put together what is the right system for you. And in most cases that I've seen, there's really only one obvious choice. So what I'd like you to understand is that all systems exist on a scale from totally mechanical to do whatever you want discretionary. And you can still have a system that gives you a high degree of freedom to pick and choose, and the more discretion you have, the better your results will be if you're performing at peak performance. Now that if you're performing at peak performance is a big if. If you're performing at peak performance in a discretionary system, you can expect at least 50% a year. And most likely in a good year over 100%. Now, what would that entail? That would entail you having some sort of routine to manage your trading psychology every day. That would mean some sort of inner work, psychological work, psychotherapy, meditation, some sort of routine like that, some sort of self-help group that would necessitate very, very comprehensive records and a lot of time spent reviewing them. It would be a full-time job. So if you're aiming to implement a discretionary system, you're looking at a very, very serious work project, which is probably going to take you a minimum of 3, and in the real world 6 months or longer of full-time work to design, test, and implement. And you're not going to want to go full speed straight away. You're going to start off trading it for very small size. Now, any sort of discretion that you have in your system places emotional pressure on you. So that emotional pressure, if you imagine yourself, if I asked you, could you walk on a board this wide? If I lay it on the ground, almost everyone could do that, right? And then if I put that board up at 1 meter off the ground, some people could still do that. But if I put the board between two buildings 10 stories high, that would be a lot more difficult. When you work up a discretionary system, you can't just jump in. If you've got $1 million account, which so 1% of that is $10,000 risk per trade, you can't just start a brand new system risking $10,000 per trade on a discretionary system. You're gonna make mistakes. So working up a discretionary system is dramatically more complicated. There's more steps. You have to start small and work your way up as you're performing well. So discretionary systems are the hardest to build. They're the hardest to backtest, because backtesting is pretty much irrelevant, so you can only really forward test. So you have to be very careful that you're dealing with an edge. So discretionary systems have the greatest chance of you getting things completely wrong and trading something without an edge. Now, I can show you how to minimize the chance of that. The point I want to make is that you don't really get many free lunches in finance. If you want to go for these systems that'll make 50, 100, 150, 200% a year, they are more difficult to execute. They are more difficult to build. And I'm going to show you how to build them, but they're just more difficult. On the other end of the spectrum, we've got a type of system that I personally don't really care for. It's just a bit too boring for me. They're called portfolio rebalancing systems. Generally, the way they work is you're taking a small list of either large cap stocks or ETFs, and once a quarter or once a month, you're rebalancing your portfolio, holding a portfolio of the strongest of them. It's a very simple concept. It's an old concept. It's a real concept. Generally, they outperform the market by a couple of % a year. Now, there's a certain type of person that outperforming the market by a couple of % a year is a job well done. That's all they want to do. You know, if you're saving for retirement and you've got some savings already, you can work out, put it in a compound interest calculator. I can go from here to my financial goals with taking very low risk. So these portfolio rebalancing type systems are for people who are really risk averse. And these discretionary systems are for people who are really kind of like roll the dice type people. Now, if you're a young person, you can afford a do-over if you make it up. So I would say be willing to roll the dice, you know, is my opinion. So let's look at some other types of systems. So let's look at mean reversion systems the quant way. The automated mean reversion systems are generally the way that most people run them, and they're a common type of system. They're one of the most common types of systems used by investment banks. The methods are very standardized, and we're going to go through them all. You need to know programming, and you need to know some maths. You don't need to be great at maths, but you need to know some university level maths. And so for a lot of us, that just, well, you need to program, you need to do university level of maths. It's all too hard. So that may not be for you. So let's look at a different type of system. Let's look at stock-based mean reversion systems. Now, these are a very interesting type of system. They generally do about 20% to 25% per year compounding. They take about 75 trades a year, sometimes more, in most systems that I've seen. And typically you're buying a stock and holding it for between 1 and 3 days. And so what they're usually doing, the normal way of doing it is buying oversold stocks in an uptrend, because mean reversion works best in the direction of the dominant trend. They only work with stocks, FX and futures. You need to apply mathematical tests to the price series to see if the price series is in fact mean reverting, and not all price series are mean reverting, but stock markets as a general rule are. So stock-based mean reversion systems are easy to execute. You don't need any chart reading skill at all. In fact, most mean reversion traders don't look at charts, because you're buying these things that look really ugly charts, hoping for a quick bounce. So they can suit a particular type of person who's very methodical and a serious trader who just wants a black and white set of rules to follow. So typically in stock-based mean reversion systems, you don't have any discretion at all. There's no, I like this one, I like Apple, I hate Amazon, you know, I'm a Google guy, I like it, whatever. There's none of that. There's here's the setup. I have to take the setup, and I'll do it again tomorrow. So emotionally, they're a very easy type of system to trade. So let's look at another type of system, which is momentum systems. Now, momentum systems are based on a really old principle of markets. The strongest stocks in the market tend to continue to be the strongest stocks in the market. So, for example, Amazon has been strong for many years, and it continues to be stronger than most other stocks. So the way that momentum systems work is typically you're buying a portfolio of the strongest stocks around a ranking methodology that you build. Now, momentum systems have some pros and cons. Momentum systems have one job, and that one job only is to beat the market. So if the stock market is going up, your momentum system's job is to beat the market going up. If the stock market goes into a bear market, momentum systems switch off, so they lose a little bit of money, but they don't lose a lot of money. They don't trade in bear markets. So if you go through a 10-year bear market and you're trading a momentum system, you just won't take any trades for 10 years. So that can be frustrating if you're a certain type of person. Now, your options are to slot in a different sort of system for a bear market, and I'm going to show you some of those too. So the next type of system that we can look at is a classical trend following system. Now, trend following systems are some of my favorite type of systems. I know a lot about building them, and one of the huge advantages of trend following systems is that there's about $400 billion worth of hedge funds and institutional money trading these trend following systems, and they all do very, very similar things, because when you understand trend following, there's only a few different ways to do it. Now, trend following has some advantages for the beginner trader. You don't need to read charts at all. You don't need to know anything about reading charts. All trend following systems are very, very similar. So they're nearly always putting a trend filter on. So some sort of mechanism of deciding, is the market going up, or is it a bull market, or is it a bear market? And if it's a bull market, they're buying breakouts. And the breakouts can be Bollinger Band breakouts, they can be Donchian channel breakouts, which are the most common, they can be Keltner channel breakouts. There's a couple of ways to do it, but in a strong trend, any of the common trend following systems will get you long at all the same thing. So the advantages of trend following systems are that they're completely non-correlated with the equity markets. So that's a wonderful thing. If you've got a big equity portfolio already, the last thing you want is another system which just builds you another equity portfolio, because what happens when the stock market goes into a bear market is you lose a lot of money. So the beauty of having a stock portfolio and a trend following system is that if the stock market takes a dump, your trend following system will almost certainly outperform. And what sort of compounding rates can you typically expect with trend following systems? They're not amazing and they're not bad. They're typically between 15 and 20% compounding. Now, the advantages of them is that the execution is trivial. So if you miss, you don't have to, you should be at your screen every day, but if for some reason you missed a day, it wouldn't be the end of the world. It probably wouldn't cost you any money at all. Now, the execution of them is so easy that anyone could do it. So it's a wonderful choice for a serious, methodical, like an engineer type, or someone with a solid maths background who's used to thinking systematically, who doesn't want to try and get every trade right, but is happy to make money in the long term. Now, the downsides of trend following systems is that they typically have win rates between 25 and 35%. And of those winners, only about 1 in 5 winners will be a big winner. So the problem with trend following is that there's a huge degree of luck in it. So you might have to take 20 trades to get one massive winner. Now, the problem with that is that means by definition large drawdowns. So trend following systems will typically have very regular 25% drawdowns and occasional 50% drawdowns, and some trend following systems even larger than that. Now, in the system building course, I've got some radical ways of reducing the drawdowns in trend following systems, which are really exciting, and I'm excited to show them to you. But we'll do a deep dive on trend following systems later. Now, another type of system that you can build are types of systems that I have a lot of expertise with, which are pattern-based systems. So you can build these either for intraday charts or for daily charts, which is my strong preference. And what you're looking for is is patterns, things which repeatedly occur in the charts, which are reliable. So if the same thing happens, that most of the time it behaves the same way. Now I'm going to show you how to test whether those things are edges or whether you're just fooling yourself. And because it's very easy to fool ourselves and think that certain indicators and things work when sometimes they do, sometimes they don't. So that's my own particular favorite type of system. You can build extremely high expectancy systems with it. The downside of it is that backtesting is quite problematic because you're testing the complex interaction of a number of things. Backtests tend to be fragile, so you have to do a lot of work with scatter plots in advance to make sure that you're dealing with an edge before you go any further. Okay, now let's talk about what sort of market you should be trading. Now, many times beginners want to trade the option market because they think that there's the highest return there. Now, the option market is dramatically more difficult to trade than any other market. In my opinion, you shouldn't be trading options until you've got a solid history of a couple of years profitable trading in some other instrument first. Now, why is this? It's because the extra variable that you have to get right in options is time. And now that it sounds easy, get price and time right together, but it's like going from juggling 3 balls, which almost anyone can do with some practice, to 4 balls, which is really, really hard. So my advice is to steer clear of options unless they're option writing systems. Option writing systems can be highly, highly profitable and wonderful systems in low volatility bull markets. Now, the problem with building option writing systems today in February 2018 is that we're coming to the end. We're not necessarily at the end, but we're closer to the end than the beginning of a bull market. So I personally would be very cautious about building option writing systems at this juncture. So let's look at the stock market, which is the easiest market by far to trade. It's the safest market. If you've never done any trading before, it's the obvious place to start. Unless you're intraday trading, your returns are going to be very, very dependent on what the overall market is doing. So we tend to think that we're these incredible stock pickers picking the right stock, but 70% of us picking the right stock is really the market going up and it floating every boat. So if the stock market is doing well and you've got a stock trading system which is an edge, then you're probably going to do very well. But if the stock market becomes bearish, then your system is not going to perform, obviously, and you either need a mechanism for switching your system off or for slotting in a different system. Now, if you're dependent on the system for income week to week to week to week, you have to pay rent or whatever, daily chart stock systems may not be a good choice for you. In that case, you may be better off looking at an intraday system, simply because you need to take more trades. If you're taking hundreds and hundreds and hundreds of trades, then the effect of having 5 bad trades is it just evens itself out very quickly, and you can still take the money out that you need. Okay, the FX market is a market that I've traded most of my trading career, and I really enjoy it. It's not as dangerous as people think, but when you trade FX, you're working without a net. So any single mistake that you make in terms of not having a stop loss on a trade or trying to do your own thing, bending the system rules, is potentially fatal. So FX market and the futures market, which is my favorite market, these markets are only for people who are really serious about following a set of rules. Absolutely. Like, personally, I would rather die than walk away from my screen with an open futures trade without a stop loss resting in the market. To me, that's impossible, because any single mistake that you make in the futures market or the FX market, they're both very similar, is going to really, really hurt you. Now, the futures market is one of the best, probably the best market, in my opinion, for intraday traders to trade. If you want to be a day trader and build day trading systems, the futures market is deep and liquid. You're never going to get any slippage. It's a wonderful market to trade. It's regulated. Personally, I think it's a very good option for the very serious, experienced trader who wants to build particularly intraday and also daily chart systems. Now, the last market that I want to cover, it's the cryptocurrency market, which is a new market. It's completely unregulated. It's full of scams. It's full of problematical things. There's hackers trying to steal your bitcoins. There's all these scam altcoins. It's effectively the Wild West, but it's easily the most profitable market to trade right now in 2018, and it's a boom bust market. It goes up and it goes down. So who is it suitable for? Who is it not suitable for? It's categorically not suitable for people to trade with a life-changing sum of money. You can't put 50% of your net wealth into it, but you can comfortably put 50% of your net wealth into a portfolio rebalancing stock system, right? You can comfortably put 50% of your net wealth into a stock momentum system if you're running it right. But you can't put 50% of your net wealth into cryptocurrencies because they regularly drop 30% in a day. So it's just not suitable. Now, if you're designing cryptocurrency systems, the big thing to remember is that all cryptocurrencies are very heavily correlated and related to each other. So to buy any of these small coins, you have to buy Bitcoin or Ethereum first and then trade that. So these are all super related. So when the money flows in, it all flows in through the one door, and when money flows out, it flows out through the one door. So it causes these incredible up moves and these incredible downdrafts. So when you design cryptocurrency systems, you have to be very aggressive with banking profits before you get that downdraft. So typically when you're running, say, a stock momentum system, you're running a trailing stop. You're exiting where you're holding the stock as long as it keeps going up. You exit when it starts going down. If you run that same system with cryptocurrencies, the drop down is going to be 60%. It's going to wipe out all your profit, right? So cryptocurrencies, you have to be dramatically more aggressive with taking profits, and also you have to be taking profits before it's too late. So cryptocurrencies suit a couple of different types of people. They suit young people who understand the tech. They suit people with very small bankrolls. So if you had $1,000 bankroll and you were planning on doing some trading in 2018, I'd say cryptocurrencies, roll the dice, go for it. You know, it's not quite pure gambling. It's one step from gambling, but it's probably one of the greatest bull markets we'll ever see. So if you're young enough, or you can afford to lose the money that you're playing with, if it's just play money, I'd say go ahead, roll the dice. It's very, very easy to build cryptocurrency systems because they all behave the same way. So when things behave the same way, it's very easy to isolate repeating behavior, and when we can isolate repeating behavior, we can build reliable systems out of that. Let's just recap a bit. So we spent a lot of time today talking about our system goals and our personal capabilities of what we can achieve. And we've gone through an overview of some of the different types of systems, not all, that you could build. Now, typically everyone wants to jump ahead to the flashy parts of building systems, like entry techniques, like trade setups, like things like that. But there's this old story about if you give me 5 hours to cut down a tree, I'm going to spend 4 hours sharpening the axe. And that's what we're doing here. There's no point just jumping in and building a system that doesn't suit us. What we're trying to do is build something really, really useful for us. So the way to do that is to really isolate our goals and our capabilities. So by now, hopefully, there'll be one type of system that we've gone through that's standing out in your mind as being probably the obvious one for you. So I want you to have a think about that. Now, if you could do me one favor, if you could leave a comment telling me what you thought of the video, or telling me which sort of system is more interesting for you to start building, we can move on with the next video next time. Thank you so much. Bye-bye.